CTM. What's going on, everyone? I hope you're well and doing great. We have a spectacular session ahead of us. We're going to be covering everything from the current launch of quantitative tightening to the PMI print today. We're going to be looking across equity markets. We're especially going to be looking across Bitcoin and the cryptocurrency markets. It's going to be a good one. I hope that you have the time to watch this to completion. I'm glad that you are here. It is good that you are here. Wherever you are right now in the world, good morning, good afternoon, good evening. If you're new here, this is Jordan with Conquer Trading and Investing. And if you're not, welcome back. Today, June 1st, we're looking at the launch of the quantitative tightening program by the Federal Reserve. We're seeing 1.1 million US dollars to be withdrawn from the market per minute. And of course, everyone's looking as quantitative tightening starts. When is going to be the next big crisis? Thank you so much, everyone. I'm just glad that you're here with me. Look, here's how it works. If at any point in time that you appreciate the time being shared, go ahead and smash that like button. If you learned something new, go ahead and smash that like button. And if you believe that this video is worth sharing with someone else, go ahead and do it. This is going to be a good one today. We got a lot of work to do. You all know that's what we do. We put in the work each and every day, and it does produce many, many fruits. But it takes that type of work ethic to get where we're looking. The last time the Fed ran QE, it unexpectedly had to stop in September of 2019. Now, any investment bank that you would have asked about their projections of what quantitative tightening was going to look like, when it was going to end, was way different from what happened in reality. And that is exactly what's going to happen today. Whether it's myself, you, or anyone else out there, it is very difficult to forecast the future and get it right. All as we can do is consult multiple vantage points. Oh boy, that's a beautiful lead into what we're going to look at a little bit later. Yeah, I'm going to wait until we get there, but you're going to see some of the work that we've done in the past and how it adds up to today. It's going to give us really, let's say, an edge going forward. All right, so here we go. It was that spike in the repo in September 17, 2019 that caused the Fed to stop quantitative tightening, to reverse course and start expanding their balance sheet again. I just want you to take a quick peek at this over here. Here we have March 2018 when quantitative tightening started. You could see this massive amount of liquidity that's out there right now. And last time they started the QE program, you could see that all of a sudden that was sucked up, right? It wasn't until September 2019 that we saw that spike in the repo rates, that breakage that caused the Fed to reverse course and to start actually expanding the balance sheet again. And then it was sometime afterwards, it was about 6-7 months later, in March 2020, ignited by the global lockdowns that caused the massive breakage, the next big crisis. A lot of people are looking for that crisis right now. Everyone's a little scared as the Fed is pulling away, and not even only pulling away. We're going to take a look at what's going on and whether or not they might need to actually shock and awe. Again, we'll just take it as it comes. You could probably hear my excitement. Sometimes I get a little riled up, and it's passion that you're hearing. It's a passion for the markets. It's a passion for learning, and it's a passion for sharing, and it's a passion for teaching. That's what you hear over there. Let's continue over here taking a look. I just want you to quickly, briefly see. This is the S&P 500 in this bright green. Below it is the Fed's balance sheet as quantitative tightening began. Notice how quantitative tightening continued to run. And as it's running in this part over here, it's continuing to run over here. You are seeing risk trading up. Now, this is interest rates below. This is the Fed's fund rate. And this is where they made that policy error. They shouldn't have hiked over here. They did hike over here in December 2018, but the market knew at the time that was going to be the last rate hike. and then you could see they move on pause before cutting rates, and risk traded up. YQT program continued to run for half the duration of the program. And then here you have the problem September in the repo markets. And then you see the balance sheet expansion beginning. And then you have when things break. So it's quite interesting. I think it's worthy to point out that last time things broke, the last time that the markets broke, it wasn't during quantitative tightening. Well, that set it up and triggered the eventual breakage, but QE was running when the markets broke. I think that's something that should be pointed out to everyone. So what are we looking at? This is a brief segue. Right now, of course, we're looking at quantitative tightening, the pulling away of liquidity and a reduction of the balance sheet. Just a reminder, right? We're looking over the next 50 years, we're looking at $150 trillion spent towards climate change. That's going to roughly be $2 trillion in the form of global QE every year as we launch, or as the Federal Reserve today launches the quantitative tightening program. I think it's worthy to mention what's happening in the future, and everyone knows what's going to happen medium to long term. Right? Traders are more focused on how over the next few weeks. And that's what we want to focus in on today. Before we do that, though, and we're going to get to today in just a moment. Before we do that, I just want to take a look at, you can see the circled over here in red. This was a market rally of 15% in the equity markets, S&P 500, rallying 15% after Bear Stearns, an 85-year-old investment bank, went under. This is in 2007. And that's set up, by the way, most people at that point in time, they thought, oh, okay, we saw Bear Stearns go under. The worst is out of the way. That's all resolved. And then all of a sudden, everyone started taking on risk again, but the problems were not out of the way. And I just want to give you some perspective about that Bear Stearns bounce, and just lining up over here in orange where we currently are right now. And I know that, everyone is very hopeful that, this gigantic storm is going to pass, and potentially they're going to kick the can down the road. For sure, there's a chance, there's a possibility that we are looking at some point in time in 2022 that this current tightening cycle ends, and that they pause and or stop the hiking cycle. I'm not talking about quantitative tightening. I do believe that's going to run until something breaks. I want to emphasize that last time something breaking was not the markets. This was when something broke September 17th, and I have it obviously right over there. You could see the spike in the repo rates, and then you see the Fed had to reverse policy and start QE expanding that balance sheet, and then things broke, much later, 6 or 7 months. All right. Now, is it possible that the Fed is going to be able to kick the can down the road to pause these rate hikes? I personally, I give more weight to the rate hikes than to quantitative tightening. We only have one quantitative tightening cycle to go off of. That's not much data at all, but it's all I have. And I don't think what we saw roughly 4 years ago is going to repeat itself. Yeah, it's not usually how things work, but we want to always consult what similar situations happened in the past to give us some type of bearings. And in the past, it was not the quantitative tightening, it was the rate hikes pausing that caused risk to rally. All right. Bringing it back over here. Is it possible the Fed is going to be able to pause rate hikes in 2022 and that we see a super big risk rally at the second half of 2022? Of course it is. It doesn't appear that today now, does it? We'll talk about that in 1 second. I want everyone also prepared for it during these we're in unprecedented times and uncharted territory. And I just want to make sure that a lot of people learned over the past year, over the past 6 months, actually the lesson and importance of managing their risk. And we might have a long way to go and a lot of pain to go. And I want everyone, even if you feel it's late, to have those important, and we're going to talk about that on Bitcoin this very day, where exactly that next level is, because we've talked about 53,000. We talked again about 35,000. What's the next level? I think we all need to be aware of that, because we don't know what the future looks like. Not one of us has any type of crystal ball. All we could do is work together and try to stay on the right side. Today this is just perspective, today we had the PMI numbers, and you could see that the manufacturing PMI numbers came in better than expected. Now, what's significant about that, or why that's important, because it really matters whether the Fed is tightening into a slowing economy or a growing economy. Historically, anytime the Fed is tightened into a growing economy, you've seen equity markets, risk markets go on to make new all-time highs. If the Fed is tightening into a slowing economy, that could very much be bad news bears. And why on the surface, this seemed very good. If you dig further into the numbers, what you're seeing, and I have this article over here. Please let me go ahead and just share it in the comments in case anyone wants to pull it up, because I'm not going to get very much into it. But the punchline is that right now we're seeing, slower growth. We're seeing slower growth is not leading to slower price acceleration. We're going to come back to this one phrase in 1 second. Now, I just want to read some headlines, some bullet points off to you. That's coming from this last article that we just saw. I never clicked on it. I imagine it is. I'm going to go ahead and click on it right now. Yep, it's the same one. Inflation is sticky and degrowth is not slowing it. We're going to come back to this one point in 1 second. It's very important. Okay. Today we saw the Bank of Canada, They had a 50 basis point rate hike, and we're seeing tightening globally right now as inflation is running hot across the globe. I know Janet Yellen didn't see it coming. She said that she made a mistake again, and she really didn't see she didn't believe that massive money printing was going to cause inflation. I know that most of us did, and very early in the moment it was happening, we were talking about that being uber asset inflationary, which was correct. We were talking about that, why people were looking for an insolvency event and the next crash. We were talking about, well, they just overreacted, and there's going to be a while before that next crash. Anyway, one problem here, though, that we are continuing seeing, the job numbers are continue to be super strong. The Fed is trying to, because of this inflationary pressures, they're trying to slow down growth, And they have two mandates, though, and one of them is jobs. And as long as the job market remains strong, they really don't have the cover to go ahead and pivot Anyway, JP Morgan, never trust an investment banker, It's a hurricane. You better brace yourself. You know what? That comes to mind. That reminds me of earlier this year in March when we saw headlines that the U.S. intelligence was warning that Russia was momentarily going to invade Ukraine. Now, it was hard to believe because the history has it that most of the time, weapons of mass destruction, that intelligence has been wrong. So when they were saying that, I, for one, didn't believe them. But sure enough, they were as right as could be. And it could be the case with Jamie here as well, And we got the Fed started QE today, and we're seeing the markets tumbling. We're not seeing the markets, in my opinion, tumbling because of quantitative tightening starting today. We're seeing the markets tumble because we are seeing that the problem here is that the slower growth is not leading to slower price acceleration. The catalyst for today's price action came after today's PMI print. That's why I said that I have my eyes on the PMI numbers coming out at the top of the hour right before they did. These type of tweets don't get much interaction. I would like to get a lot more people, especially those involved in crypto, paying attention to how the markets work so that we are stronger together. All right, let's keep going. And we see, by the way, when we talk about the ISM, the future forecasts, though, are very bad. Here we go. We're looking at further weakness as far as forecasts coming in from manufacturer surveys. And we're going to talk about this in 1 second. We're going to start getting into the markets. We're going to be taking a look at the Nasdaq right now. We are currently in a very, very strong downtrend. Ever since that bounce that started on the FOMC March 16th, and we saw that nice bounce. And since that bounce has been faded, Sell the Rip took place a lot quicker than I imagined and a lot more violently. But here it is. And since then, we are very much in a downtrend, a strong downtrend. And you want to trade with the trend. You want to stay in the direction of the momentum. However, right now you could see that price, this was obviously yesterday, was pulled away from the trend. I know everyone was eager to sell the bounce. Timing is everything. Wait for that down momentum to continue to return. The question is, has it today? We'll take a look at that together in 1 second. And I just want to end this portion of today's session with this over here. Now, this is coming from, I think they're called Phoenix Capital Research. And the truth is that ever since, well, for the last 2 years, they've been looking for the markets to crash over and over and over and over and over again. And obviously, the markets went on an extraordinary bull run off of the March 2020 lows until November, December 2021. Nevertheless, the whole time they're looking for that crash. Hey, listen, it doesn't mean you shouldn't consult all vantage points, because eventually they're going to get it right. Historically, right? This is very important, bold over here. Once inflation is in the financial system, the Fed cannot stop it with half measures. That means that in order for the Fed to truly bring inflation to task, it will need to be aggressive. That's going to mean shock and awe. Now, whether or not the Fed is going to kick the can eventually in this year, or whether or not they're going to actually have to come in harder, I do not have the answers to those questions. I really would like to participate in those conversations, though. I think that is very important for all of us to continue with. Now, let's keep going here today. By the way, I hope you're all well and doing great. Before I get going on this next section, I want to take a moment over here to check in with all of you and see what's going on in the comments. Yep, David has a great question. So if I'm strictly following CTM 2.0, do I even need to care about things like PMI, etc.? David, two-part question. Definitely not, and of course not. Now, the other part of that is, if we are looking at something taking place, David, like this, at that point, you might want to obviously be not participating on the buy side only, and you might want to, following CTM 2.0, make sure that you are participating on both the sell side and the buy side, and that's why it would matter, right? So does that make sense, David? You want to make sure that you are definitely covered, and that's a decision that everyone needs to make. By the way, of course, if you're following CTM 2.0 on the buy side only, you could just be out of the market. A lot of people saw that at April 4th, April 5th, Bitcoin was trading at $45,700, and CTM 2.0 took you buy side only out of the market up until just this Sunday, right? And that was the first entry back into the market. So those are the things that you need to be thinking about. Great question, though. And then let me just jump back over here as I continue looking what's going on. And David, there's another follow-up question I want to take. I get paralyzed by info overload and miss entries and exits. I believe for me, I will be better with a simple system. And I'm hoping 2.0 is it. Not only simple, elegant, right? What I truly deem to be the holy grail. And I attribute that all to the CTM hive mind. There's no question about that. David, yes. The one thing that I wanted to add to that, though, David, was that if you were following a systematic mechanical strategy like that, you have to take each and every entry and exit. You cannot be discretionary in deciding whether or not you choose to take a signal or not. It's you follow all system signals. All right, John, thank you very much. Thank you very much, John. I appreciate it. You know what, John? And we talked about this briefly yesterday, after all that we have accomplished in the last 2.5 months, I am really looking forward to now being able to, as you saw this morning, get back into basically the overview of the markets and just digging in to where a lot of our passion lies. It is very exciting. I mean, I imagine it's going to be a lot like Japan. The question is, who will buy U.S. Treasuries when they get better rates, return on other securities? I imagine they're just going to continue to monetize the debt. That's what I imagine. There's a lot more to talk about as far as the macro, and we will continue that conversation, including if you might have saw this morning on Twitter, Luke Roman was talking about that even this demand destruction is not going to cause oil prices to come down, that potentially we have seen peak cheap energy, and that before they were able to cause any type of demand destruction that would bring down oil energy prices, you would see sovereign defaults take place. You would see much higher yields on bonds. And my question to Luke, and I look forward to see what he responds, is, you know what? Hey, Luke, is there a chance at some point in 2022 that the Fed will be able to pause the rate hikes, possibly even stop them, and kick the can down the road? Or in your opinion, Luke, do you think that they're going to need to shock and awe? And again, these are all very important conversations. And then right now, we're going to just focus in on our edge on some charts. And we're going to take a look at where we might need to in the future de-risk if needed. So one further question before we get going on this next part of the session. At any point, do we need to move the stop loss to break even? I think that was answered before. Mike, that's not part of the strategy at all. Neither is a trailing stop loss. So if you're following and you're looking, obviously past performance is not indicative of future results. There's no way to know. But you want to follow the system exactly as outlined. My preferred settings include a 2.5% stop loss. That stop loss is not moved to break even. There's no trailing stop on it. It's just a straight 2.5% stop loss. I'm looking at this chart over here. I looked last night. I was going over many different chart templates, and I'm going to share some of them with you right now because they do provide, and also tomorrow's session. In tomorrow's session, I have some other interesting charts that I want to continue to share with you, but here's what we have right now. The reason I have this chart over here is for two reasons, because a lot of people right now, they're looking at something like bulls targeting something like $35,000. And I'm more focused on, this was important channel support, right? That once it broke $35,000, that was an area we talked about people who didn't de-risk at $53,000. They needed to de-risk now, right? So that broken support should be resistance on the way up. So this line over here is going to show me, because not 35,000 flat round number, but this should provide a better, let's say, a better edge, a better idea of where that resistance in the upside might lie. And also down over here, you could see this. This is, again, the prime trend line comes off the April to the November highs. If you clone it, it fits in perfectly down over here from the June and July, and then in the January lows over here. And if you clone it again and you put it off the March lows and you extend out, you could see somewhere around $20,000 looks to be a line of last resort. This is just one view of it. I also have it at $19,000. And by the way, I'm going to happily be considering multiple viewpoints and vantage points, because the more I'm able to do that, I think the better situational awareness I will continue to have. And I will continue to learn from my mistakes. One of those was over here, this line over here that we were following this channel, right? This bottom support over here. And $37,000 was a much better de-risking point than that $35,000. Now that's a small little nail that's slightly, hammered in a little bit slanted. And nevertheless, it's just continuing to learn and continuing to do it in real time that continues to make us stronger in each and every way. This over here, this was untouched. I looked at this last night, and you know what? I mean, the first thing that caught my eye, you can see this is on a log scale. By the way, it's very important to point out. And just as I talk about viewing multiple vantage points, I think the more often we get to view log and linear, just the better asset it's going to be for us. By the way, for those that are interested to know, when should you most of the time be viewing linear versus log? Log tends to be for the further you're zoomed out. That's the best time to consult a log chart. If you're trading off of a shorter time frame, if you're perhaps a swing trader or even a day trader, then you want to be focused in on the linear. For what we're looking at over here, though, I want to continue to consult both. That's what I'm going to be doing. This is on log, though. This is the one difference. And you can see you have over here this high in June of 2019, and then again back into March and April and February 2021. And that was the prime line drawn down over here. When that's extended down to this touch off the March 2020 lows, you could see this is on log scale. That's where we just touched down over there. Okay, we'll come back to that in a moment. I think that's, it's worth consulting, right? This, again, was shared a while ago before the big breakdown, and you could see that price touching that line. I would gather there's some type of significance to that. This is on log, not linear, and I think on linear that this bear flag support provided a greater edge. Nevertheless, I'm going to be consulting both. And if you extend that out, you could see that, well, it was close. That's more towards that 35,000. And actually, that also kind of gives a little bit of affirmation to the channel support over here at 35,000. And even though this is $2,000 higher, that probably was the right decision, offering that $35,000 as a level to continue to de-risk. This was also just the chart I pulled up. It's the same exact methodology that was used in the previous slide over here. Nevertheless, again, I'm going to continue consulting everything I have to have the sharpest edge going forward. Notice that if I bring this line down a little bit, right, you can see the touches over here, the touch over here, the touch over there. That looks a little better. I'm going to obviously rewind and go back to where I had it. This is very important. And again, I'm talking about over here in the beginning, the importance of this slide is for two reasons: to have the where support level might be at the bottom over here, but also for resistance on the upside. And you can see along the lines of this as well. This is a log scale chart. I don't want you to view this line right now. I want you to focus on this one over here. And this log scale trend line, which touched over here in September 2021, after the breakout, retested it. It held, except for that spike on that Friday. That's where we were able to de-risk at 53,000. You could see after that spike down, it held above it until it broke down, retested that line. The line seemed significant to me, this trend line. And then again, when it got above it, it was in play. In this area, it was not so much, but it was again over here before that breakdown of $37,000, $35,000. So I imagine, I'm going to just go ahead and extend that over, that on the upside, that might provide resistance as well. So these two, as far as resistance on the upside, I want to keep in mind, assuming that we get the luxury of actually even having any type of bounce into that resistance. Right now, this morning, it looks like the markets are really not happy, and we are seeing a sell-off across equity markets, across the crypto markets, and it's quite brutal out there. Let's take a look at this. A lot of people are very familiar with this chart, not just over here because, again, CTM, when we first went live on the YouTube. By the way, if you are new here, please go ahead and not only smash the like button, but do consider subscribing for when we do publish videos. Hit the notifications to be alerted. But in this whole area, we were looking to accumulate, calling the breakout of the bull market, the technical breakout of the bull market. And for me, myself, this is where I began lightly leveraged trading all the way up until things didn't make sense, $50,000, getting on the sidelines, waiting for that clarity. That clarity was the most important trend line in crypto. We were able to go ahead and ride wave one, then the pullback of wave two, right? The pullback of wave one into wave two. And I talked about that repair is probably most likely is going to be the best opportunity into the cycle peak. And well, that's true. It was, only I expected that cycle peak to be significantly higher than from where it was. Actually, I thought diminishing returns would be something like $160,000. And I didn't even think that we were going to see diminishing returns. Nevertheless, our exit of saying, hey, wait a second, that's not right. Something's wrong. That's not supposed to happen. We spent Thursday and Friday before the breakdown preparing ourselves here, CTM. And you could see it very clearly on what that work was. This is actually the slide we used in those two sessions to help us understand that if we broke down over here, 53,140, that if you were looking to de-risk, that was the time. I myself, during this period over here, I had actually took out loans. I was actually buying Bitcoin, and I had to go ahead and pay off those loans, and I had to de-risk in this area over here. And I think looking from here to now, it's important having this bit of data afterwards just to go ahead and view that. And here's another view of it. This is a slide that was also put out at that time, and we were waiting for the repair of wave two, for the breakout. It never happened. It's great. So it's great TA. It doesn't have to work out as you wish if it gives you the opportunity to manage your risk. And why I say it's great TA is because that breakout, it never occurred. And instead what happened was the breakdown. This slide I have up over here, I don't really know what to make of it yet. You could see the one difference is the angle. Instead of the angle touching the both peaks over here, I did it a little bit differently, touching the top of that peak and the close of that bar. And I'm going to keep with it because I don't know which is correct, to be honest. And all I did was go ahead and clone that line further off of the March lows. And you can see it gives me a lot lower, right? This is showing us somewhere around $14,000, $15,000. And you know what? If we do break down, oh, by the way, this is done off of this prime trend line over here. All these lines come off of this prime trend line. This was a line that we were using here in CTM back into late 2019, early 2020, until the bull market broke out. And this is cloned all the way up. And then if I reverse it, if I invert the chart and clone it, I get this trend line off of the March 2020 low. And if we do break down, if we lose something like $19,000, that might be where we have, that might be the level we start looking towards this trend line. That's why this chart is up here right now. This is gold. I know we're looking at Bitcoin. That's it for that little bit presentation of those past charts that have provided us so much alpha that we're looking at right now to just kind of get that lessons learned. And this is a chart of gold that I'm pointing. Gold has really done nothing. Gold continues to be like the stable coin of all stable coins. A lot of people wonder why what the work we did here really helped them when we lost 53,000 actually pivot into gold. Whether you pivoted into gold or dollars, it's pretty much the same thing. Gold over here continues just to go sideways. I imagine anyone who wishes to have gold in their portfolio, and if you're going to have gold in your portfolio, I assume that it's going to be physical gold, and I assume that you're not going to store that physical gold at home, but in a vault. And I assume that it's not going to be a vault in your own country. Otherwise, there's no point in it, that it's overseas. There's a massive third-party risk in doing that. Nevertheless, some people might be looking to diversify their portfolio. Gold plays a tremendous role in that. Is it possible under this new world order we're seeing taking place that gold will be repriced one day? I assume so. I really strongly believe that. Nevertheless, beautiful trend line over here. You could see that it's important. A lot of people wanted to buy gold as it was approaching $2,000. This might be a better time if you're looking to go ahead and get into the gold shiny stuff, because you know where you could de-risk, to be it from a risk to reward. Thank you, Jeremy. Good luck on that. Dean, so the question is, why wouldn't I hold gold? I personally hold gold. It was well over a decade ago that I took a position into gold. When I first got into the markets, by the way, I remember this massive breakout that occurred on gold, and it was $800. No, I take that back. It was, so I'm sorry, we're talking 20 years ago. So I don't remember it clearly. I don't know why 800's in my mind. It seems that the breakout, it must have been a lot lower. Anyway, maybe it was 800. I don't remember very clearly. Would I hold gold? Absolutely. I think gold is tremendous. What I'm saying is I would not hold it at my house. That's a security risk. The same way, if you hold Bitcoin in a hardware wallet, you want to use multi-sig, and you do not want to hold those keys in the same location, but you want them across multiple geographic locations. Because again, there's, first of all, third-party risk. Then there's also, if you're securing your own assets, then there's that risk as well. You have to be very prudent, and that's what's great about having conversations with different people, is figuring out best practices and ways to go about things. That's obviously a conversation for a different time. But Dean, if we want to pick that up inside the Discord, go ahead, and I would love to have that conversation. Maybe even get into it in a specific session as we move forward. And this is a past chart. This is a chart that we consulted up until the breakdown, and why we talked about the breakdown of this lower trendline support as it was happening. I want to go ahead and revisit this and the work that we were doing to show the importance of it, including this trend line over here, the dotted one. You could see that we spiked below it, but once we had the first close, this is similar to the bear flag on Bitcoin, how the 37,000 break of the bear flag was actually a better point than the 35,000. But nevertheless, even the last line of support breaking over here, the close below it, but look, it got tricky. Anyone who thinks that this is easy to go ahead and navigate when you had, again, the close above occurring right over here, very difficult stuff. Nevertheless, once you close back below it, you got to be nimble. You got to stay on the right side. Means sometimes you got to be willing to flip-flop back and forth momentarily, even including small losses in the process, to stay on that right side. And it got much harder after that. When I say it got much harder, what you're looking at occurring next is obviously then a breakdown, a retest, and that retest finally held, and then the resumption down. And look at that. It didn't get any. This is the March 2022 FOMC, and then the rip out of it. And that is a rip. And that rip was sold by a lot of people. Not myself. It happened a lot quicker and sooner than I expected. Look at that. It's just beautiful. And by often going over what happened in the past, you're able to go ahead then rewire your brain. And then as it's unfolding in real time in the future, you're able to be on top of it with your pulse a lot closer to it. That's the importance of putting the work in each and every day. That's just beautiful to me over there. And let's get into real time right now and talk about what's going on. Take a look at it. I want to introduce some new work I've been doing that we started briefly taking a look at yesterday on the indexes, S&P 500, Nasdaq, CTM 2.0. We've been able to polish up the Bitcoin, Ethereum, long side only, long and short side, GBTC. By the way, we're going to take a look at GBTC in just a moment. I was able to yesterday, really after our session, spend a lot of work and make a lot of progress over here on the indexes, not just the indexes, but into FX. I want to take a look at all of that with you right now. I think that the more eyes we have on this, the more people working together, we could take it a lot further. If you remember when I introduced in mid-March CTM 2.0, as introduced, it was great. There's no question over the next 2.5 months, we were able as a group to take that significantly further. And we might have a lot of that going on over here right now. Before we do that, let me just make sure as we get into this next portion of the session, there's not any further questions, and I want to take a look at them right now. For the rest of you who are now leaving us, I just want to say have a beautiful day. Make sure you go ahead and subscribe. Go ahead and click that bell icon, and we'll be able to go ahead and stay together and make sure that we keep our pulse on the markets. Have a beautiful day.